What's up? I'm Dan Fredenberg, and this is another Chance Encounter. Hey, what's up? I'm Dan Fredenberg. I'm a commercial real estate guy. I'm from the internet. We're seeing more properties like this being built in front of a house that's going to be torn down soon. I understand that there are power lines that are getting kind of close. What's up again? This is Dan Fredenberg, and that there is a commercial real estate building. I'm joined today with Tyson, Dr. Tyson and Cobb, right? Have I got that right?
Got it.
Okay, great. Yeah, I'm thrown off because normally I go off of the Zoom name like a dummy, but that's not important to you. I need to talk to my very favorite audience member who's joining us today. And what's going on here? This is a chance encounter where I interview commercial real estate players, and that means sometimes it's buyers, sometimes it's sellers, sometimes it's deal sponsors, sometimes it's fund managers. You never really know who. But you might ask yourself, why would you want to make a podcast like that? And the answer is, if you've ever heard of the private off-market deals that you're not allowed to publicly discuss, they're called 506B deals, then you should know that the SEC requires that you have a documented prior substantive relationship, or else they'll get ants in their pants and they might take your business away, which is absolutely no good. So I have people on here and we talk about core competencies and the contribution to these different deals and that sort of thing. And the benefit to you is you're going to learn how to more effectively communicate on the subject of a commercial real estate deal, and you're going to understand how my guest fits into that. Now, Tyson, before we get too excited about real estate, do you want to introduce yourself a little bit?
Sure. So my name is Tyson Cobb. I'm a semi-retired orthopedic surgeon. Left my group in 2019 after 20 years of full-time orthopedic practice, and went into real estate investing. And it's allowed me to work less, make more, and pay a lot less in taxes. So I like it.
Gotta love it. Gotta love it. So that gets us to the first segment of this show. And before I get to that, though, I always have to say, but wait, check your eight. Now, I don't know how technologically inclined you are or not, but maybe you can try to see through the camera up there and into the user's device, because down there might be this hideous subscribe button. And maybe the audience should do something, but especially if they have like some Generation Z around, they'll judge you for that. Okay, it's a stupid joke, but I do it in every episode. But let's talk about the distinct motivations. I've now spoken to and interviewed hundreds of different people in the commercial real estate space, and everybody has their own unique reason why. Tyson listed off a couple already, but even though people have their own unique reason why that they are involved in real estate, I find those reasons fit pretty neatly into these 5 different categories. And it's important to know what they are if you're going to be working with somebody, because after all, there are plenty of risks involved. There are, the deals take months to actually close and they take years to go full cycle. So it's important to know what's keeping somebody from throwing in the towel when the going gets tough. And the first motivation of the 5 is preservation of purchasing power. Now, what's that? See, some people, they either have a higher amount of income than they generally spend, and so they have a certain amount to allocate towards investments, or they are work optional completely. And if you're in that situation, the question that might come to mind is, well, how do you pay your bills? Well, if you have a portfolio of assets and you get the passive income from that, then that is why you would be involved in this industry in general. But if you are in that fortunate situation of not having to work, you might say, well, why would you make another acquisition? And there are a few different reasons why that might happen. One is if inflation rears its ugly head, which recently that's been a big thing, then it's going to eat away from the purchasing power of your cash flow. So it's going to be time to make an acquisition sooner than later. But the other one, and of course, everybody who's trying to make an acquisition, you should try to negotiate the most advantageous deal that you possibly can. But if you're in this situation, you're not going to pull the trigger unless you're getting at a very steep discount. And that especially happens if there's an asset crash or some sort of distress. Now, full disclosure, this is not where I'm at personally. What describes me better is trading time directly for wealth. And my background is in technology, so that made me a high wage, high salary earner. And of course, as I was doing the specifics are the CRM agency that I owned, and then that got me into real estate. But once I started working for a real estate guy who was flipping 10 houses a month, I figured that I was on the wrong side of the right industry. And so I started learning all sorts of things to do with real estate. But the important part is I wanted to start getting rewarded in the form of deployed capital, aka equity, rather than in a higher salary, because that's just going to be eaten away from taxes. So that's what I'm up to. And I get that that's too subtle for some people, especially youngsters. What they're more interested in is taking control of their schedule, or maybe hustling like crazy right now so that they can fast track their retirement. Now, the pitfall of having this mentality in a lot of people's minds is they think that honestly everybody is secretly trying to retire faster, but I assure you that is simply not the case. It might just be that people want to work fewer months per year or fewer weeks per month, but regardless, that's what's on their mind. But that's not everybody. Some people are more fueled by ambition. They want to buy their entire hometown. They want to go for that generational wealth to make sure that their great grandchildren don't even have to work a day job, and that's why they're going to hustle into their 90s. And I need to emphasize, because I know that that's somewhat vilified in some circles, but you need people who are highly motivated to take care of these properties to make sure that they continue earning, and also the people are happy with residing in those places. So I don't want people to have that attitude to think that that level of ambition is going to be a problem. But that's also not the only group who is going to realistically hustle into their 90s. The last group, they've picked a sector of society, or maybe it's animals, maybe it's the environment, who knows what it is, but they found a sector of society that they really want to help, and they found out that there's a financial component to that. And that's why they're making their commercial acquisitions or real estate acquisitions. So Tyson, as far as those 5 different motivations, what combination of them would you say describes you best?
Yeah, I would say the last one for sure. I think you go through different seasons in life. So in the early phase of life and struggles with business, you're just trying to prove yourself. And then at some point, you're trying to provide for your family. And then at some point, all the kids have graduated. You're out of that. You're work optional. And I've been in that place for a while. And I think it's during those quiet times that you find real purpose in trying to help people that are less fortunate. And I like to describe my current season in life as a parable of the talents. And that's that was a parable that was that's told in 2 of the Gospels. And the story is not exactly the same in both, but very similar. And certainly the take-home message is the same. And the master was going away for a period of time and left some of his servants in charge, and comes back after a period of time, and one servant who had 5 talents had cranked out 5 more, so he had a total of 10. And master says, good job, and basically puts him in a place of leadership, because he's demonstrated that he can handle it. And the next one comes along, and I think he had 2 maybe, and had cranked out a few extras, and same deal. He was placed in a position of greater power. And the last one comes along, and he had one, and he had buried it because he was afraid to take any chances. And he was basically cast out. And I think the take-home message for that is, for all of us, is we've been given talents in life that allow us to give back and help people that are less fortunate. And while that may be something that's not right on the front burner in the early stage of life, I think as we get further into life and all the people that are clawing at us and the kids and so forth, that's all kind of settled now, and we're either work optional or getting very close to work optional. And that's a great time to reflect on, what can we do? And so that's exactly where I am now. I mean, I'm whipping and riding as hard and fast as I can because I want to get to a point where I can give $1 million a year away. And I know I can do that through real estate. It's not going to happen overnight, but I believe it'll happen in the next decade for sure.
I love that. I remember when I was first told that parable back in my 20s. And one of the things, you can't be a doctor unless you have a good head on your shoulders. Medical school will chew you up and spit you out. And so, I did engineering, which it has some similarities in that regard. So that was always something very important for me, is building more skills instead of trying to just bury them. So that's a very meaningful story, and I can definitely relate. But the next segment I go on to, it kind of tapers off the optimistic, the starry-eyed side of the goals and the motivations, because it talks specifically about risks. And if you've ever been involved in a 506B deal, the private off-market deals, then the SEC attorney, the securities attorney who's in the mix, should have forced everybody to fill out this super invasive financial questionnaire, all sorts of questions like what's your net worth and that sort of thing, things that are uncomfortable to answer in general. But as I was going through that questionnaire, there was one question in particular that I felt it lacked utility. I felt that it didn't matter which of the multiple choice answers you chose. You couldn't really take it to the bank. You couldn't really use it. And it was the one on the tolerance for risk. So I made my own question about it, and it is a fill in the blanks question. It is, there are many popular investment asset classes, but I think blank is too risky. So Tyson, this can be inside real estate, it can be outside real estate, it can be both if you want. What's something that is popular but it's too risky for you to invest?
Yeah, so I feel that way about the stock market. It's just so volatile. Crypto, I think, is another good example. Both of those are, like aluminum pan. They heat up fast, cool down fast. And I'm not saying that you shouldn't invest in either one of those, but they certainly demonstrate a lot more volatility than real estate does.
Absolutely. And my issue with the stock market has always been that, they even have a PR department, which is a department that's, basically supposed to spin the facts in a way that's more palatable. And that's the nice thing about investing in syndications, individual deals and things like that, is you're interacting with the actual person who's calling the shots. And so I absolutely love that answer. Now, for the next question, I got to tell you, the first couple hundred guests that I had on here, I wanted to use this particular slide, but I was too coy about it because I knew that some people, they're more like the front of house, they're more like the PR, the marketing person, and they're not the kind of person who's going to be really comfortable in a spreadsheet or underwriting, doing the math and arithmetic or something like that. But it hit me that even if somebody is more on that side of this business, you're still going to have a few different deal metrics that you're going to use to distinguish one from another as far as how likely is it to succeed. So that's why I started including it. And for anybody in the audience who is just listening and not watching, I'll list them off. I've got 14. It's not an exhaustive list, but I think it's pretty good. The first one is cash on cash. Then you got IRR, internal rate of return, in other words, equity multiples and that sort of thing. Then you have cost per door. You have net operating income. You have the going in cap rate, and specifically that's more about what sort of discount are you getting compared to other properties that have been sold that are similar and in the same area. Then there's the loan interest rate, which has become more and more important over the last couple years because a lot of people try to assume a loan. Then there's the occupancy rate. Another synonym for that, even though it's the inverse, is the vacancy rate. And vacancy is, of course, the deal killer, but experienced operators have ideas on how to fix that. So that's the next one. Then there's the average income where the property is located. There's the amortization period of the loan. It's especially important if somebody was overusing bridge loans like they were about 4 years ago. Then there's the difference between the market versus in-place rents. There's the population growth where the property is located, because if you've got population growth, that means increased demand. Therefore, you've got a little bit of baked in appreciation more likely than not. Then there's the sponsor record, which is how many deals have already gone full cycle, how many deals deals are on the go right now. Then there's the waterfall, split, or exit strategy, which is mostly about what happens to your investment after the deal has completed, after your capital has been returned or something like that. Then there's DSCR, which is debt service coverage ratio, which is really about how much of the revenue is going out the door immediately just in the form of paying off the loan. So Tyson, as I mentioned, that's not an exhaustive list, so you're welcome to add any others, but if you want to give a top three or something like that as far as the ones you focus on.
Yeah, so I think all those are important. Some are more important to some people than others, and some are more important at certain times than others. So for instance, your interest rate and your DSCR are very important for a lot of deals that are crashing right now, right? So they went in with short-term variable rate loans. The Fed cranked the interest rates up, sucked all of their cash flow out. Now they don't they don't have the 1.25 debt service coverage ratio, and they can't get refinanced. So these people are forced to sell at about a 30% discount right now. So there's some good deals to be had out there, if you find those. I think those are exceedingly important now, and probably less important moving forward as the interest rates go down. If I were going to pick one off this list, I think IRR is probably one of the more sophisticated measures. Certainly the sponsor record, I think, is extremely important. But again, I think they're all important. And you just have to kind of know how to use the different tools depending on what you're doing. If you're closer to retirement and you want the cash flow, then the cash on cash is more important. And I tend to look at equity multiples because if I'm going to get to $1 million a year to be able to gift, I'm going to have to crank out some pretty good equity multiples to grow the net worth and double it with each rotation, which is the goal right now, and it's doable.
I love that answer. I'm gobbling it up like a delicious subscribe sandwich. Isn't that beautiful? It's okay. It's a little bit intense. I admit it, but it's really my reminder that it's time to pull out the Dan Does Deals Commercial Core Competency Cube, and it's got the 6 different main roles in a commercial real estate deal. And the importance of it is it really helps you put into context, where does my guest fit into these deals? How do they work? What are the essential parts of the team? And as I'm explaining it, if you are thinking, hey, I really need to get one of those cubes, the good news, it's absolutely free. You can go to dandoesdeals.com, and there's this big conspicuous button where you can click on it, go straight to the PDF, you can print it out, and you can practice on your friends and your family. The importance to you, as far as I'm concerned, is I do think if you're going to have commercial real estate as part of your career or your investment strategy, I think your success is going to depend on your ability to effectively communicate on that subject. But I need to confess, yes, you heard me right. I committed the cardinal sin of marketing, which is you should always ask for some sort of contact information in return for your freebie, and I didn't do that because it's really, really important. So that's why I go through all 6 sides, and the first one I want to talk about is the repositioner, because they're the most visible people in a deal. What's a repositioner? That's a person who's a deal finder, but not only that, they have to do some underwriting, they have to dig deep into the spreadsheets to find out things like, hey, is this property actually even making the amount of money that the seller/broker claims it is? Because right? But I call them repositioners. A lot of people call these guys investors and these guys investors and these guys investors. I like to have clearer terms about it. And a repositioner's talent is also to figure out how to make that property make more money than it is right now. In other words, finding that upside. Now, the most peculiar part of being a repositioner is you're going to have a vast network of financiers. Those are people who only deal with paper and money and the owners of the property. They do not deal with tenants. They're not on the GP team, as they call it. They simply are dealing with those finances. And the reason why repositioners need to have that network of financiers is because if you can secure where a more advantageous loan, in other words, cheaper money, that goes straight to the profitability of the building. So that's why you need to know lots and lots of them. But the more traditional spot, the more intuitive spot that a repositioner is going to find that upside is to take a look at the operations and stop those Benjamins from going down the toilet. Now, of course, there's more to operations than just unclogging toilets and collecting rent and things like that. Me personally, when I'm a GP and historically, it's more about my tech and marketing skills where I contribute, because at the end of the day, vacancy is the enemy. And even if you are looking at bigger properties like I tend to be involved with, the real issue is that if the operations, the third party operators that are really taking care of the day to day, if they can't fill those units, somebody with some serious marketing chops needs to step in and get those units filled. And that's where I throw my hat into the ring. But of course, there's only so much you can do with operations. So frequently the repositioner will find that upside by getting a contractor team involved to do a value add. In other words, upgrade the units, because if it's a nicer place, then people will theoretically be happy to pay more in rent than the previous residents. Now, of course, if only things were that simple, you can spend endless amounts of money on your contractors. You can go ahead and gold plate the toilets if that's your thing, but I don't expect you're going to get a good return on investment. And if you're like me, see, I don't know if you know this about me, but I'm from the internet. So that means I need locals. I need boots on the ground, somebody who can be there in an hour or two, because categorically that's not going to be me. I'd be stuck in an airport in an hour or two, and you need to have somebody who can be there. And their primary job is going to be keeping an eye on the contractors, make sure they're not using subpar materials, making sure that they're keeping the schedule, and then also keeping an eye on the operations to make sure that they're not sloughing photos and information and all that kind of stuff. But to understand the last, the second to last, it is the last one, the last roll on this cube, I need to use a little bit of a hypothetical. So my guest Tyson, he's a physician. So typically one thing I run into with physicians and engineers and attorneys is they go, well, hey, I know how a rental works. You know, I put down the deposit and then I borrow the rest from the bank. So sometimes they'll get their circle of friends and say, hey, I bet if we each throw in $100K each or something like that, we could buy that apartment complex down the road. So full of confidence, they go down to the financiers and they say, hey, I want to buy this 350 unit apartment complex that's tens of millions of dollars. You don't happen to have, say, tens of millions of dollars you want to lend us, do you? Well, there's one thing that's going to be a little fly in the ointment, so to speak, which is the financiers, the banks are going to say, who's your KP? Who's your sponsor? What's that all about? So banks need to make sure that you actually have the ability to run this business, and you're not just going to take their deposit or cash and then run it into the ground and make the principal unrecoverable. The way they do that is they make sure that somebody in the fold already owns a similar asset, or else you're simply not eligible as a team to take over the property. On top of that, you need a certain amount of liquidity, and you need a certain amount of capital, basically collateral, to that's worth at least the amount of the loan. But if you have all those pieces, you got yourself a commercial real estate deal. So Tyson, as far as where you fit in, I'm sure you have a lot of financier relations, especially with your background as a physician. I'm sure there's going to be some underwriting involved in asset management, but I don't want to put words in your mouth there. So where do you fit in most likely into your next deal?
Yeah, so my superpower is bringing people together. I've done a ton of research as a physician, and I continue to do that now. I research teams. I research the properties, what's the upside. I research the geographic location. What's the job growth? What's the population growth? What's the crime? Just looking for all those levers. And when you can kind of check all three of those boxes where you have a good team, a good property, and a good location, you're probably going to do well. Now all you need is some people to come together and create syndication. So you bring the LPs in with the GPs, and now you have a team and you make it work.
I love it. I love it. So that brings us to the buy box. And when real estate people are saying, hey, what's your ideal property? What's your buy box? That sort of thing. We're really asking about three main things. The first one is geography. Where is it? Okay, you can't just say, "Hey, I got this building, come take a look." We need to know where is it, which state, which county, possibly even which neighborhood. It's definitely going to matter for you to call it ideal. The second one, it has to do with the size. And when you're talking about multifamily in particular, which is apartment buildings, the way that you define size is by the number of apartment units. The unit count is what we generally call it. The reason why it's relevant is because some teams focus on 10 or 15 unit buildings, and then others focus on 150, 350 unit apartment complexes, and the teams involved are going to be fundamentally different. So that size is going to matter. Now, of course, there's other types of commercial real estate, and maybe they go by square footage or maybe they go by acreage, but the same thing about size applies. But the third one, I like to call it desirability, but the more common term is class. And the reason why I got a problem with class is because it's really two different things all tried to smash into one. Those two things are the condition and the area. If I'm talking about condition, you're talking about how old is the property, how beat up is the property, what kind of luxuries and amenities does it have. If you're talking about the area, especially when you're talking about multifamily, the school districts where the property is located is going to be very relevant. But every type of property out there, every type of commercial property, the crime rate is going to matter. And then I also like to throw in that other trope you hear from brokers all the time of location, location, location. I don't think that gives you enough information, because what I think they really mean is traffic, traffic, traffic. If you've got a gazillion people passing by that property every single day, it's automatically going to be more desirable than one that's basically crickets. But it doesn't matter if you're talking about that area or if you're talking about the condition. The way you rank it is the same way as in grade school, where you got A plus at the top, and then A, and then A minus, and then B plus, and so on. So Tyson, as far as you and your organization goes, where's the sweet spot? What's your buy box?
Yeah, I like the B class. It's not to say that I wouldn't do an A or a C. It depends on the location. Obviously, with a C, you have to be careful that you're not in a high crime area, and the type of state you're in. So I don't want to get political here, but if you're in a blue state with C property, and you have something like COVID hit, you may go a year and a half and not get paid. So that could be a problem. Some of the A properties, depending on the location, there's been a fair amount of new properties that have come on, and that depends on the geographic area. So I think if you're in an A property where there hasn't been a bunch of new properties that have just recently come online, that's not a bad place to be either. Certainly, I think the tenant class is easier to take care of. I like multifamily a lot as far as asset classes. I think there's a good runway left there, because we know that the starts are down. So I think we've got a pretty solid runway at least through 26, maybe beyond. Yeah, so I mean, I think that's, I hope I answered your question.
Yep, definitely. And I love how you frame that. I think that in the media and whatnot, it's been framed rather poorly, because at the end of the day, the question is, who owns the property? Is it the government or is it the owners? And so that's why I don't think that, the normal tenant-friendly, landlord-friendly way of framing the argument, I don't think it's fair to anybody involved. So I'm glad you put it that way. But that's more stuff about people, which is my segue into the next segment. Everybody out there is looking for people of some sort, and it's honestly my favorite part about commercial real estate. Because it's a team on every single deal. The fact is, people are so eager to give referrals, to build new teams, even if they're not involved. But at the same time, we all have our own unique skill sets, so we're going to be better prepared to help some people more than others. Now, of course, I should add that at the end of the day, if you're in any form of real estate, especially syndications, that kind of stuff, you're ultimately in the business of deploying capital as well. So everybody's going to be on the lookout to meet more financiers. But on top of that, depending on what your skills are, you're going to be looking for somebody else as well. Me personally, because of my tech background and my marketing skills, the sponsors and KPs are the people who I generally try to pursue the most. I find that I can help them because they've already got a foundation put together where I can make a bigger difference. Whereas when you're just first starting off as a repositioner, as a local, that sort of thing, you need somebody who's going to be putting in 80 hours a week or something like that. And that's simply just not how I'm at my biggest contribution. So that's what I'm all about. Now, Tyson, I don't know if you stick with 506c deals, and so therefore it's accredited investors, and therefore you can say whatever you want, or if you do 506b deals. If you have a 506b deal on the go, don't go ahead and mention that in the same breath as looking for passive investors, financiers. But who's out there in the audience that you can help the most?
Yeah, so we currently have a boutique hotel on Carolina Beach that pays a 16% preferred return. So people are looking for high cash flow, which I'm in a ton of real estate investments right now. And with the economy and the interest rates, a lot of them had to stop paying distribution. So, I feel like this is good timing for a really high pref type of play. It pays monthly starting the month after close. It's set to close the end of September. And, I think it's a great return and not something you see very frequently.
That's definitely fair. So then the question on everybody's mind, I'm sure, is how to reach out. And I'm just going to go ahead and sandbag that for a second and talk about myself. I'm fortunate enough to have this really distinct last name right here. So I'm really easy to find, especially on LinkedIn, which is the social media platform where I spend most of my time. Of course, I do have a few different books on Amazon.com. You can check that out. They're on different business skill building related subjects. But if you are going to be raising capital, in other words, if you're going to be taking on passive investors, especially if they're going to be non-accredited, I do encourage you to maybe pause the video. You can scan this QR code right here because that goes to the FAQs page of 506BME, which is the platform where I offer the service of documenting your substantive relations for you and maintaining them, because even if your laptop falls into the bathtub, that's not going to be a good enough story to the SEC because they are going to need to see the documentation of your substantive relations, or you could be fielding criminal allegations of fraud after they come after you. It's really, really serious stuff. But Tyson, I know that you're also active on LinkedIn. I've seen you some of your posts on there. Is that the best way to reach you, or is there a website that's better? How should people reach out?
Yeah, LinkedIn works on Facebook as well. And our website is timberviewcapital.com.
All right, beautiful. So the last thing I have, it's actually my public service announcement. So it's not for you, it's for you in the audience. And of course, I admit I'm not a medical professional, but if you've been experiencing searing pains in your eyeballs and like migraine-like symptoms, I'm confident it's because of the downright hideous subscribe button that's still down there. And if you hit it, I'm sure it'll stop. Okay, full disclosure, I want a lot of people to hit the button so that YouTube pays for these videos instead of me. I think that would be fantastic. And the trade-off to you is my videos may show up on your list of suggestions. You can go ahead and ignore those suggestions. I think the Chess with Investors series is particularly fun to watch, but that's up to you. The fact is, though, I just really appreciate the fact that you spent this time with me. Just like Dr. Tyson, thanks for joining. This has been great.
Dan, it's been fun. Thank you.
All right, awesome. Hey there, are you interested in commercial real estate deals? Would you like to build your network of investors and deal sponsors? Well, the best thing I can do for you is have you appear on a chance encounter interview as featured on dandoesdeals.com. You may know me from 506BME or as a top commercial real estate voice on LinkedIn. And if I had to think of the top factors in your success in commercial real estate, my top two would be your network and your ability to effectively explain how deals work with effective communication. The 15-minute chance encounter format, it checks both of those boxes, and they ensure that you can share your private deals with me without the SEC calling it a public solicitation. So hop onto LinkedIn. You can see my name is over here, Dan Friedenberg, and search for my name. And the best way to reach me and book that is to message me through LinkedIn. And don't worry, it doesn't matter if you decided to enter this space just last week or 2 weeks ago, or if it was decades ago. It'll be fun and easy to look good. We're just asking multiple choice questions. based on your core competencies you look to contribute, your level of sophistication, all that kind of stuff. So I hope to hear from you soon.
Does
Thanks a
nothing
lot.
but put
Bye.
more money in the pot.
Right.
If we talk about just the investor side, I mean, Shane talked about the sponsor side a little bit. I'll talk about the investor side. Okay, so you want the most money in terms of return with the least risk. All right, you want to do it yourself, you can go get 13 or 14%. You're going to do all the underwriting, it's not going to be passive.
If you bet, probably not.
I think I'd have to bet at least 2,500 before they fold.
And the pot is
4,000.
4,000. Yeah, I think you're right, but I'd rather just check.
Okay.
First position, you have the right of collection and the right of foreclosure or sheriff's sale, well, you know, wherever you're at.
Make sure you 506B me. Any syndicators, make sure you 506B me.
Hi.
Oh, hey, yeah, here's my code. You got your QR code scanner? Okay, yeah, oh yeah, just hold it right in the square there. Okay, cool. And now you hit open in browser.
Okay.
Okay, are you already logged into 506B me?
Yes.
Yeah, okay, cool. Yeah, so there's my video. So now I'm already on your watch list. So when you get back to your hotel, you can find out what my core competencies are and my level of sophistication. Sound good?
Yeah.
I love your hat. Real estate's a scam. That's really funny.
Yeah. It's funny.
Nice meeting you.